Most investors don't fail because they pick the wrong asset. They fail because they pick the wrong role. And that's the dangerous part. It doesn't show up immediately. It shows up 3 years later when you're exhausted, overextended, and quietly resentful of something you thought would create freedom. Multifamily real estate is powerful and it can generate real wealth. It can generate durable income. It can change the trajectory of your family's future, but it will also magnify misalignment. And misalignment compounds just as aggressively as good decisions do. So before we talk about multifamily, before we talk about operators, before we talk about passive investing, I want to give you a lens into one of the most powerful tools I teach. And I'm going to show you exactly how to use it for yourself. Because most people don't struggle due to lack of information. They struggle because they never assess themselves honestly before choosing a path. Today, I'm going to give you the framework I use to prevent that mistake. It's called T.E.R.M. Time, exposure, risk, money. If you misunderstand even one of these 4 variables, it can build something impressive that quietly destabilizes your life. And halfway through this video, I'm going to walk you through a financial scenario that makes this misalignment painfully clear. Stay with me, because this isn't about what you can do, it's about what your life is structurally built to sustain. If we haven't met, I'm Adam Williams. I'm the founder of Elevest Capital. I've been investing in multifamily real estate for over 20 years, and last year alone, we transacted on over $200 million of multifamily and added more than 1,300 units to our portfolio. I'm not anti-operator. I'm not anti-passive investor. I'm pro-alignment. After 2 decades in this business, here's what I can tell you confidently. The investors who win long-term are not the loudest. They're not the most aggressive. They're not even the most intelligent. They're the most structurally aligned. They choose a role that matches their design. That's what T.E.R.M helps you see. Let me introduce you to 2 investors. On paper, they look identical. Both earn $400,000 a year, both are in their early 40s, and both want to build passive income through multifamily. Both are disciplined and financially literate. They each decide it's time to get into real estate. From the outside, they have the same ambition. From the inside, completely different design. The difference comes down to 4 variables: time, exposure, risk, and money. T.E.R.M. Investor 1, the operator path. He decides to become a general partner. He joins mentorship programs, underwrites deals nightly, spends weekends touring properties, raises capital from friends, guarantees loans. His time commitment, 15 to 25 hours per week minimum. His exposure, he's now responsible for staff, debt, execution, performance. His risks, liquidity risk, reputation risks, legal risks. His money, he puts $250,000 into his first deal and he signs on the loan, but he feels empowered. Year 1 looks exciting. Year 2 gets a bit stressful. Year 3, one renovation goes over budget, rates move, one partner underperforms. He's still earning strong income at his W-2 job, but now he has a second full-time problem. He built equity, but he also built weight. Investor 2, the capital allocator. Same income, same goal. But he chooses to remain focused on his core career, the thing that already generates high cash flow. He allocates $250,000 as a limited partner into a diversified multifamily portfolio. No loan guarantees, no asset management calls, no operational burden. His time commitment, review quarterly updates. His exposure, economic only, not operational. His risk, limited to the capital he invested. His money, working without replacing his identity. Year 1 feels slower. Year 2 looks stable. Year 3, he has distributions flowing. His income is intact. His stress hasn't doubled. On paper, they're both in real estate. Structurally, they built completely different lives. And this is where T.E.R.M matters, because most investors don't choose based on structure. They choose based on ego, and ego doesn't show up on a spreadsheet. Let's break this down a bit further. Same $250,000 investment. Real estate investor A, the operator. You acquire a 100-unit deal. The purchase price is $15 million. You raise $3 million in equity. You own 20% of the general partnership. If the deal performs perfectly, you get an 8% preferred return, a 2x equity multiple over 5 years, and you get the promote upside. Your projected total profit could be strong, but here's what rarely gets discussed. Let's assume renovations go 15% over budget. Interest rates reset higher. The refinance window tightens. Cash flow pauses for 12 months. Now you're on lender calls, explaining delays to investors, managing capital shortfalls, injecting additional liquidity. Your $250,000 isn't just invested, it's attached to your time, reputation, and guarantees. Your upside is higher, but your volatility is exponentially higher. Now let's talk about real estate investor B, the limited partner. Same $250,000, you invest into 3 diversified 200-unit properties across different markets. Each deal targets 7 to 8% preferred return, 15 to 17% IRR, no personal guarantees. Now let's assume the market's tighten. Distributions dip from 8% to 6%, but you're not on calls daily, you're not restructuring debt, you're not capital calling friends, your exposure is defined, your downside is contained, and over 5 years, you generate consistent cash flow. Your W-2 income remains focused, your stress load doesn't double. Now here's the uncomfortable math almost nobody takes into consideration. If your W-2 produces $400,000 annually, and you dilute your focus by 20% chasing operational upside, you just risked $80,000 per year in cognitive bandwidth. And over 5 years, that's $400,000 of opportunity cost. Suddenly, the higher upside math doesn't look so obvious. This is where most investors go wrong. They calculate return, but they don't calculate roll costs. And roll costs compound invisibly. Now let's break down the T.E.R.M framework directly and show you how to assess yourself with precision. Because if you skip this self-audit, you won't know you're misaligned until it's expensive. T.E.R.M is how you choose your role. Time. How much can you sustainably allocate for 5 years? Not excited time, sustainable time. If your current career already demands 50 hours a week, becoming an operator isn't adding income, it's replacing margin. Exposure. Exposure isn't just capital. It's operational liability, it's reputation, it's debt guarantees, it's decision fatigue. Are you built to carry that? Or do you want economic exposure without operational weight? Risk. Not theoretical risk, I'm talking about emotional risk tolerance. Can you handle suspended distributions for 18 months? Can you handle investors calling you during the downturns? Or would that destabilize your focus? And money. Liquidity matters. Operators often need concentrated capital, but limited partners get to diversify, which gives you more resilience. Now let's layer this in with something deeper, the passive framework we teach at Elevest. Because T.E.R.M helps you choose your role, passive helps you evaluate the structure itself. Predictability, alignment, safety margin, scalability, inflation resilience, volatility exposure, and exit clarity. An aligned investor matches T.E.R.M to passive. An ego-driven investor who wants control ignores both. Let me be very clear. I believe deeply in multifamily real estate. It's how I built my family's wealth over the last 2 decades. It's durable, it produces income, it scales. But I also believe in something else. Not everyone is built to be an operator. And that's not a weakness, it's design. The strongest investors I know understand their role. Some build companies, some allocate capital, both can win, but only if aligned. Misalignment doesn't show up in year 1. It shows up when markets tighten. That's when structure matters most. At the end of the day, this is an identity decision. Are you a hope-based investor, chasing upside, chasing ego, chasing visibility? Or are you an income engineering investor, designing structure, protecting bandwidth, building durable cash flow? Neither is wrong, and both paths can create wealth, but one will feel stable for you, and that's the difference. If you're serious about designing correctly, here's what I'd suggest. Go to elevestcapital.com and book a call. We'll evaluate your goals, your current portfolio, your income targets, your time availability, and whether multifamily and in what role makes sense for you. My mission is to help people like you create real wealth and passive income through investing in multifamily real estate. It's how I built my family's fortune over the last 2 decades. And in my opinion, it's one of the most trusted ways to build lasting wealth. And in the next video, I'm gonna break down something related. How to evaluate a multifamily operator before you ever wire capital. Because choosing the right role is step 1, and choosing the right partners is step 2. I'll see you there.